Okay, sir, I want to talk about some of those potholes because let's start with one because a friend of mine was struck by this. It's known as spouse's liability. Explain the pothole, I'll call it a pothole, regarding spouse's liability.
Well, the issue is that you may have a spouse that's in a business and you may not have anything to do with that business.
Nothing.
But because you have, that money goes into your joint checking account or those kinds of things, all of a sudden you now have liability for what it is that the spouse may not be paying. We've had some very, it
can be sad.
It can be sad. It can be very sad because somebody can be actually not involved at all, and all of a sudden, because of the law, because of the way it reads, they all of a sudden have some liability.
Is there anything a spouse can do in advance of a problem to protect him or herself?
Well, make sure that if you have nothing to do with the business, that's clear. That you're not, for instance, a corporation. Sometimes, you're there, the spouse is automatically put on the board as a secretary of the board.
And that's what happened with my friend.
And even though they have nothing to do with it. Well, all of a sudden, you become an officer of the corporation, you are now in. Or make sure the money then that's going into that goes into a separate bank account rather than the one that you keep as a family. Those would be things that would help you do that.
Speaking of separate accounts, you would recommend to Californians, especially business owners, that there be a certain segregation of funds to make sure taxes are paid in a timely fashion. Explain that, sir.
Well, what happens is, businesses are truly doing a service for California by collecting a sales tax.
And explain that. We forget that. That's
right.
How they really are.
I mean, and in some states, and I wish it was true in California, the state actually gives them back some money for the time that they do of collecting the tax. California doesn't do that, unfortunately.
Okay.
But
change that.
Yeah, I'd love to. I'd love to, but unfortunately, I don't think we've got a legislature that's open to that. But the idea there is that they are collecting the tax and then remitting it. In the law, in the true law, it's actually the business owner who's responsible for the tax. The law allows for them to collect it from the citizen out there, the person who's making the purchase, but doesn't require that. So anyhow, the business owner has to do that. So what happens with businesses sometimes is, you just had a really tough month. And so you just say, well, I'm going to use that money I collected for sales tax, and I'm going to help pay for something this month.
Bad idea.
And next month it'll get better. And next month it doesn't get better. And that's really why we truly say, hey, it's better off just to write the check, set it aside, so you're not tempted at that point.
How often are businesses supposed to remit the sales tax?
Well, it depends. Usually it's once a quarter, but you could get a monthly or you could get an annual, depending upon how big your business is. But usually they remit the sales tax about once. I'll tell you, there's another real key one there too, and it's called successor liability.
Oh yes, yes.
This is one that I really,
deadly.
I get I feel so sorry for sometimes. Somebody buys a business, and they do it on a handshake, because they were the cook at the restaurant, and the owner says, "Hey, I'm thinking about selling my business. You want to buy it?" Cook says, "Great, I'm going to go ahead and I'll do that." And so they just handshake, and all of a sudden that individual, the cook, now begins writing checks, and all of a sudden, and they just found out that all of a sudden the previous owner had a tax liability. And now all of a sudden that becomes their tax liability. So it's really important when you buy a business that you get a certificate of tax paid from the Board of Equalization. Because that means you've gone to them, you've said, hey, is there any taxes owed on this business? And if they say no and send you a certificate, you're not going to be responsible for that. But if you don't, the idea is that somehow you were in collusion potentially with that individual, and now you tried to get them off the hook, and you got them off the hook, and now it's you. And so it's really dreadful, because people really go into it with the best of intentions, and then all of a sudden find out that the guy that they thought was their best friend is no longer in California, and they end up holding that whole bag.
And along those lines, what that tells us is we need to keep records for an extended period of time.
And that's really hard, because you know what happens? I find that people are enthusiastic and excited about starting their business, and you know what? They are people who are they're restaurateurs,
they're creative,
or they're dry cleaners, or they're whatever they are, and they're not tax people. But it's so important to get a good start. That's why we offer tax consultation. Everybody who takes a new permit in my district, which is a quarter of the state,
right.
I send them a letter saying, hey, look, I will send somebody out there to sit down with you and help you know what it is and how it is that you need to go through your tax issues before they even start their business.
Wow.
Because the problem is, if all of a sudden they ignore some little thing, 3 or 4 years later when they get their audit, it's a big thing. And it's enough to put them out of business.
His name is George Runner. He is a member of the Board of Equalization in the state of California. My name is Brad Pomerance, and this is California Edition.
California's Board of Equalization administers programs which account for what percent of all state revenue? 15, 25, 30, or 50%. BOE administrated programs accounted for more than 30% of all state revenue.